Italian Pie is proud to support WYES and this episode of Wall Street Wrap-Up, and to promote the importance of financial literacy and education.
This week on Wall Street Wrap-Up, a Manhattan grand jury indicts former President Donald Trump on state charges but tries to link it to a federal crime. A stretch? We'll talk about it. Federal bank regulators called SVB and Signature Banks asleep at the wheel during this week's Senate Banking Committee. And today is the end of the week, the month, and the quarter. So how did we do? For all of the above, we'll tell you that too. I'm André Laborde. We've got these stories and more. It's Friday, and it's time for Wall Street Wrap-Up. Hi, I'm André Laborde. Welcome to Wall Street Wrap-Up. It's Friday, March 31st, 2023. Well, coming up tonight, we'll be talking about bank failures, how you can get 9% dividends on your money, and what's Warren Buffett buying. Because in just a minute, we're going to be talking with the Associate Editor of Barrons, Andrew Bary. Andrew's coming up. Well, a local Manhattan grand jury indicted former President Donald Trump, first time in the history of the Republic. It's a controversial move because Manhattan, New York DA Alvin Bragg is a local district attorney stating the case hinges on federal election laws, which the U.S. Justice Department oversees, and they passed on it. Well, the government today released the PCE, or the Personal Consumption Expenditures Index, for February, and the results were good. The Federal Reserve looks carefully at these numbers to see if their rising of interest rates are having an effect of the slowing of the economy. Well, it seems to be working because the markets liked what was being reported and showed it in buying more than selling of stocks. So, with the new PCE numbers this week, what's the sentiment on Wall Street? Now remember, the stock market moves in forward earnings and sentiment. Now, according to a recent Delivering Alpha CNBC survey of 400 investment managers, when asked about the S&P 500, where does it go from here? Over half of them that it feels there's more room to fall, while 16% evenly feel we're closer to a bottom, and an equal amount feel that it will begin to rally. So, that's what the survey said, but how did the S&P do this weekend? Well, for the first quarter, the leaders were tech. That was up over 20%. And communication services was up over 19.5%, followed by consumer discretionary at almost 15%. And the laggards for the first quarter were financials. Well, that's easy to understand with the banks dropping almost 6.5%, and energy was down just over 5.5%. So how did our money do this week? Well, it was a green screen this week with all the averages up. This week, the Dow Jones Industrial Average closed today at 33,282, which was up over 3.2%. And the S&P 500, they closed today at 4,109, up 3.5%. And the NASDAQ, they closed today at 12,223, up 3.3%. And the S&P 500, they have 500 stocks, but these 7 stocks alone move the whole index. Now, in fact, just Apple and Microsoft, they account for 13.3% of the S&P 500 weight. And small and regional banks are under closer scrutiny by the Federal Reserve and Congress. There's $270 billion in commercial mortgages coming due this year, with many landlords having trouble filling their offices, and tenants, they're giving up their leases. And 70% of the commercial real estate loans in this country are held by regional banks. So, will landlords be able to continue paying their mortgages without the tenants? Let's find out. Andrew Bary is the Associate Editor of Barrons, and he's here with us tonight. Hi, Andrew. Welcome to Wall Street Wrap-Up.
Glad to be here with you.
Andrew, you had a great column in about a week ago at Barrons about how the big banks are a better buy right now than the smaller regional banks. Do you still think that?
The bigger banks are a somewhat safer investment right now. They have more capital. They have bigger deposit bases. They're more tightly regulated, and so they're probably a better value right now. I mean, the regional banks are cheaper in terms of price right now, But all banks are on sale right now. It's been a tough year for the entire sector. I mean, the big banks like JP Morgan, Bank of America, Morgan Stanley, Goldman Sachs, Wells Fargo, you're talking about getting 3 to 4% plus dividend yields. They're trading for often 10 times earnings or less. And in some cases, they're trading pretty close to their book values.
I would assume at this time that the FDIC, the Federal Reserve, they're going to be tightening standards on banks, both small regional banks and also the larger banks. Will this be meaning tightening credit, which will be less loans, but also meaning less revenue every quarter?
Yeah, I mean, I think there's going to be a tightening in lending standards and regulation. I think capital standards may be boosted, in particular for regional banks, which could hurt them relative to the larger banks. There's been a big disparity in capital. The biggest banks have had to hold more capital. And at the margin, you're seeing lending standards tightening, particularly for real estate, commercial real estate loans. There's a building problem in the office market for commercial real estate in terms of getting financing for that. You're seeing that play out in the sharp decline in the price of a lot of office real estate investment trusts or REITs now in the stock market, companies like Boston Properties or Vornado or SL Green. So yeah, it's playing out right now. Whether it has much impact on the economy remains to be seen. It's a question of whether or not this is more isolated or more generalized in terms of tightening lending standards.
I think it was in your column or in Wall Street Journal or Barron's, they were talking about how this year in 2023, about $80 billion of commercial real estate is going to have to be, their loans are going to be ending. So they're going to have to either have like a revolving, continue the loans get new loans, or they're going to have a problem with less people going to offices and now working at home or doing other things. Do you see a problem that's looming later on this year with $80 billion worth of commercial real estate having to be refinanced?
Yeah, I believe you're referring to commercial real estate loans that back office buildings, which has been the toughest area of the commercial real estate market. Areas like multifamily housing or warehouses have been held up relatively well. Office has kind of become the problem area because of the work from home trend, which has diminished demand for office space around the country. It's clearly going to be a problem. You've already seen defaults on a number of real estate loans backed by offices and commercial real estate. I mean, here in New York, it's happened. I mean, generally what happens is these loans are only backed by the property themselves and not by the issuer. So basically, they effectively hand the keys back to the lenders.
It was reported this week they had the vice chair of the FDIC was on with the Senate Banking Committee. And he had said when it came to SVB, Silicon Valley Bank, that about 2 weeks ago on a Thursday, when all of the problems, the bank run was starting, that within like 4 hours, they had $42 billion that was taken out of SVB. And then they found on Friday morning, the SVB contacted the regulators and said they're looking at probably about another $100 billion. So between 48 hours, you're looking at about $142 billion being taken out at one time. Well, they didn't have the money. They didn't have the deposits for doing that. And it was all because of, it was the communication was because of social media. You know, today, like with Twitter and Facebook and such, as compared to, if you remember the movie It's a Wonderful Life with the bank run with James Stewart and, at the Bailey Building and Loan. I mean, are we going to have to really be thinking with communication, or how will the FDIC have to be going in the future with social media?
Silicon Valley Bank was particularly vulnerable because they had a lot of large deposits above the $250,000 FDIC limit. The vast bulk of their deposits were uninsured deposits, which is kind of hotter money from institutions and others that are more prone to move money out. I mean, most of the big banks have as much as half of their deposits that are retail deposits, checking accounts, savings accounts, which tend to be less hot in terms of are less prone to move. But clearly there's an increasing problem. And obviously the problem that banks have is despite the liquidity they may have in terms of cash, I mean, most of what they own is securities, which they can arguably sell, but also loans. And you basically can't like monetize a loan quickly. So it's clearly a problem. And the risk is rising for the banking sector.
At SVB, the top 10 depositors were $13.3 billion. So, about, give or take, about $1 billion per depositor. Some was a little more, some were a little less. But the top 10, $13.3 billion. So it clearly wasn't the normal consumer, the mom and pop and such like that. How do you feel about, or what are your thoughts about the FDIC and Treasury is contemplating just insuring everybody, not just those for $250,000 or less, but even those that are over $250,000?
Well, I mean, they may have to do that. They've not explicitly said that they will guarantee deposits of above $250,000. They did so in the case of Silicon Valley Bank and also Signature Bank in New York to basically avoid a run. But down the road, I mean, that's something they've been wrestling with. I mean, Janet Yellen was kind of like going back and forth about this whole issue in the last week or so, and it caused some controversy and some roiling of bank stocks as she was speaking there. And I think many people assume now that deposits are guaranteed, even though they're really not explicitly done so by the government.
Is something like this, of the guaranteeing even above $250,000, would you know offhand, would the FDIC or the Treasury have that type of authority, or would that have to be a Congress because that would be allocation of money?
That's an interesting question. I'm not quite sure regulatory-wise, legal-wise, and legislative-wise what has to happen, but I know the federal regulators tend to have pretty wide authority to act during what they view as financial crises or times of dislocation to basically make these moves. But to do it permanently might require legislation, and it'll be interesting to see whether or not that's something that the legislatures are willing to do, the Congress is willing to do.
By insuring over the $250,000, that would maybe a subjective way or an implicit way of maybe rewarding bad behavior on executives?
I don't believe so. I mean, I think no bank wants to fail. No bank wants to go under. I mean, the executives from Silicon Valley Bank are going to be in court. They're basically are going to spend the next couple of years of their lives dealing with the aftermath of this. I don't think any of them wants to go through that.
What about the raising of the $250,000 cap? Right now, as we're talking, there is a $250,000 below you're guaranteed by FDIC. Above, well, that's what we're just discussing, whether or not they're going to be insuring. Do you think that they're going to be now thinking about raising it from $250,000 insured to maybe $500,000?
That's certainly possible, or maybe to $1 million. I think it's been at this level for quite some time. So, I mean, it's not really kept up with inflation. So I think you'll see that. But I think the broader issue is whether or not it should be a more blanket policy across all deposits. And many investors and many analysts and observers think that effectively that's what the FDIC has done and the government has done here. But it's not being done explicitly.
The average consumer, when they hear things like $250,000, I mean, the average person may have $10,000 or less, in a checking account, in a savings account, maybe a CD and such. But it's the small and medium-sized businesses that have to make payroll, have to make inventory payments. Those are the ones that may have over that $250,000. What do you think going forward some businesses will have to be doing? I mean, do you think that they are going to spread the risk? They're going to have to be going now to other institutions?
The bigger banks are going to be beneficiaries because they're believed to be, too big to fail, and that I think any business is not going to worry too much about having their payroll handled by J.P. Morgan or Bank of America or Wells Fargo.
As you said, I mean, many businesses will feel very comfortable with a Wells Fargo, with a J.P. Morgan, with a Bank of America and such. But a lot of local loans, from commercial to home loans and other types of small business bank loans, are done by the small regional bank. Do you think that this is going to shrink or put a lot of the small regional banks out of business because so many depositors are going to the larger banks?
I don't believe so. We'll have to see how it plays out. Many of them have deep relationships in the community, and I think they tend to have a high degree of insured deposits and don't rely as much on broker deposits or large deposits. So I think there'll continue to be a place for smaller to mid-sized banks throughout the country that have relationships with businesses in their communities. And I mean that's been their strength and their calling card for so many years, is that they're not big and impersonal. They can be more adaptive to local communities and local needs.
People are pulling their money out of a bank because they're getting such a small yield and maybe going somewhere else. Do you think banks would really shot themselves in the foot by offering such small yields on savings accounts, on certificate of deposits, that they would have more deposits if they offered more yield?
Well, I mean, I think you're seeing outflows of deposits from banks. It's not been a large amount, but you're seeing that at the margin, people who are moving money out that they don't really need for transactions into money market accounts or treasury bills or higher yielding alternatives to the 0 to less than 1% they're getting in the bank. And I think people are comfortable having, let's say, $5,000 or $10,000 in a zero interest rate checking account because they need it for their for needs in terms of making payments and expenses, and you're also getting a very good service for that. I mean, the bank doesn't charge you for having a checking account, and you get a debit card, you get checks, you get the ability to contact the bank if there are any problems. I mean, they're providing valuable services in return for basically getting your money for essentially no interest rates.
Well, do you think that if the FDIC is going to start charging more for, let's say, insurance, FDIC insurance, or they're going to be needing money to, if they're not making the loans out, they're going to start going, let's say, higher NSF checks, or like what you were saying, they may start charging for accounts that haven't been used over 2 months or 3 months, or keeping less of a deposit in certain checking accounts that may be free now, but they'll be starting to charge.
I mean, I don't think there's going to be any move toward that. I mean, I don't believe I've seen or heard much of that going on. I mean, in fact, I think banks have been getting more lenient in terms of no fee checking accounts. I mean, if you have direct deposit, I mean, in most banks you can get a free checking account with a relatively low balance, and the bank is not making a lot of money on a $2,500 or $5,000 checking account. I mean, they're basically handling a lot of transactions for you over the course of a month or a year. And, if they're making, let's say, 3 percentage points of interest spread on that, or 4 percentage points of interest spread on $5,000, that's $150 to $200. I mean, you're getting, a reasonable amount of services for that kind of money. If you were to pay to get those services, you'd probably pay a lot more if you had to buy that a la carte somewhere else.
And the jury is still out on this, but I'm wondering if whether or not banks like SVB or Signature or First Republic, I think Wall Street Journal or Barron's had a recent article on how the founder at First Republic, he had some of his relatives that he was giving business to from First Republic. Do you think that they're going to find anything improper or illegal with either the FDIC, Treasury, or any of the alphabet agencies looking into this?
I mean, I think they're going to take a very hard look at this, and I think it's relatively isolated, and you can't defend it. I mean, I think some of these loans may have been somewhat improper, but I think it's too early to judge it. I mean, we don't know all the details of it, but it doesn't look great. But I mean, if the loans were well collateralized, I mean, I'm not quite sure. I mean, why that's a problem for the bank. I mean, I know the optics aren't great for it, but generally, I don't think banks make loans that they don't intend to be able to recoup payments on. So I think. I mean, let's wait and see what we see about this as it comes out.
You, in one of your columns, you were talking about Altria. Now, what is the Altria? A lot of people think of as Philip Morris or the cigarette maker. And you were talking about how they're increasing their dividend. Do you find that Altria is a good investment for higher dividends?
Well, for people who like dividends, there are few better plays in the stock market than Altria, which is the parent of Philip Morris, which is the maker of Marlboro cigarettes. It's the biggest cigarette company in the country. I mean, the stock trades around $44 a share. The dividend is over 8%. It's one of the higher yields in the S&P 500 index, and the company takes its dividend very seriously. It's raised it for more than 50 straight years. And it recently projected that it sees annual dividend increases in the mid-single-digit range going forward for the next 5 years. So that dividend, I mean, if they make good on what their guidance is going even higher.
Does it matter, like a company like Altria, they've got the power of pricing so that, let's say, possibly if their sales are going down with cigarette smoking in certain areas, they can always raise prices to overcome any type of sales?
Well, I mean, the big debate about Altria has to do with, cigarette volumes and just the direction. I mean, the direction has been down. It's been down for 40 years. It's accelerated in recent years, and the stock's actually been weak in the last year. It's down over 15% from the high 50s into the mid 40s, and that is a major concern. I mean, as cigarette consumption was down about 9% last year, it's expected to fall at a mid-single-digit rate this year. They've been raising price to compensate. They've been doing that for a long time, and cigarette smoking is addictive, and cigarette smokers are brand loyal, which has helped Philip Morris, helped Altria, helped Marlboro. The average price of a pack of cigarettes of Marlboros is now over $8 around the country, which is expensive, particularly since the smoking base skews lower income. In places like New York, where they're very high taxes, like $15 a pack.
You many times appear on Barron's Roundtable, and you were talking about NVIDIA, and NVIDIA it's a very good stock. In fact, I think from year to date, it's up about 75 to 80% so far from January 1st until now. Is that the only tech stock you're very high on? Do you still like NVIDIA? Do you think that tech is a good buy as a general sector, or just that one particular stock?
Well, I'd be cautious on NVIDIA now. It's probably one of the biggest companies that many Americans have never really heard of. It's the fifth or sixth largest company now in the S&P 500 at over $600 billion market value. It makes a lot of high-performance chips, which basically power servers and other cloud computing devices that are being used now, particularly for alternative for artificial intelligence and chat GPT and things like that. And so the stock's up 80% plus this year. It trades for about 80 times this year's earnings, which is a very high valuation. The market multiple is closer to 20. So I'd be a little bit cautious on NVIDIA now. You can buy, cheaper tech stocks like Alphabet or Apple or Microsoft and others like that, which you're paying closer to 20 times earnings for rather than 80 times earnings.
Andrew, I know you follow Berkshire Hathaway quite a bit, and it was reported this week that either Berkshire Hathaway as the company or Warren Buffett himself, he's now increased his percentage of Occidental Petroleum now to like 23% or 23.5%. Do you think energy in general is a good play? Do you think that there's something about Occidental Petroleum that Warren Buffett, it seems like every time it hits 60 or below, he starts continuing to buy more and more till, like I said, now he's up to about 23.5%.
Yeah, Buffett likes the energy sector, and the purchases are made by Berkshire Hathaway, not by Buffett personally. He orchestrates the purchase as the CEO of the company. Berkshire now owns about 23% of Occidental. It owns almost 10% of Chevron, which is the number 2 oil company in the country behind ExxonMobil. I think he believes that oil and natural gas are going to be very important parts of the energy scene and energy usage for decades. And even though he's 93 and won't be around to see all that, I think he's probably right about that. Renewables are coming on stream and taking share, but it's going to be a very slow transition away from fossil fuels. And these companies are pretty well positioned for that right now.
Well, Andrew, I know Charlie Munger's 98 now. I think Warren is the kid at 93. So I think he's if he takes any type of advice from Charlie Munger, I think he's going to be around for a few more years.
No, it's true. I mean, Munger's actually 99, Buffett's 92, and they're both as sharp as ever. Investors will be looking forward to the Berkshire Hathaway annual meeting on May 6th down in Omaha, which is really the only time of the year you get to see Buffett speak. Buffett and Munger will be there holding forth for 5 or 6 hours. It's always a treat, always a lot of insight and humor and fun, and he really enjoys it. And he is as sharp as ever at 92. He doesn't miss a beat. It's incredible what his mind is like at obviously an advanced age.
True. Andrew, I've had a great time. I hope you come back.
I'm happy to be here. I'm happy to come back whenever you want.
Thanks a lot, Andrew. Well, if you have a question or a comment about the show, we'd love to hear from you. Make it concise, make it pithy. Write us, and also notice the new email address at andre@benacapital.com. Well, let's look ahead at the market heading into next week. But first, what state was purchased on this day in 1867 by Secretary of State William Seward that newspapers around the country referred to it as Seward's Folly? We've got the answer in just a moment. Well, what state was purchased on this day in 1867 that newspapers around the country referred to it as Seward's Folly? Alaska. And it was purchased from Russia for $7 million. I'm sure Russia would just love to have that property back. As they say in real estate, it's location, location, and location. Well, let's do a wrap-up on Wall Street. Netflix is now cracking down on password sharing. Investors are happy, and the company ended its third straight positive quarter. Netflix estimates that 40% or 92 million people are getting free accounts. Well, it was Schultz versus Sanders this week. Former Starbucks CEO Howard Schultz was in front of a Senate committee this week defending his company against accusations of retaliation against union officials. And are we getting ahead of our skis? Tech executives this week sent an open letter calling for a pause in AI, or artificial intelligence. Included in the senders were Tesla's Elon Musk and Apple's co-founder Steve Wozniak, and even presidential candidate Andrew Yang. In the letter, they're asking for a moratorium of 6 months or more to give the industry time to set safety standards, and saying we've reached the point where these systems are smart enough that they can be used in ways that are dangerous for society. Yikes. And that's a wrap-up on Wall Street Wrap-Up. So join me next week when my guest is going to be Bloomberg entertainment editor Felix Gillette and New York Times media reporter John Coblin. They've written a great book about HBO. In the age of streaming and cord cutting, how much are they spending on programming, and how are they competing up with Disney Plus and Peacock, Netflix, and all the other competition out there? That's next week. Bloomberg's Felix Gillette and John Coblin from the New York Times. And that's our show for Friday, March 31st. My thanks so much to Andrew Bary of Barrons for joining us tonight, but especially I want to thank you for allowing us into your homes this evening. Have a great weekend ahead, and with the ones you love, and a productive week ahead. I'll see you next week. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm André Laborde, and remember, money never sleeps. Good night.
Italian Pie is proud to support WYES and this episode of Wall Street Wrap-Up, and to promote the importance of financial literacy and education.